Hello everyone. In this particular recording, we're going to go through the homework for Chapter 12, which is the investments chapter. So we've studied all sorts of assets in this class. The last asset that we're going to study is this asset of investment. And the reason that we're keeping this for the last study for assets is the fact that I wanted to show you in previous chapters that companies, in order to raise money, they can issue debt, like bonds. We talked about that in the liability chapter, as well as they can sell stock, common stock and preferred stock. We studied that in the equity chapter. So those are two ways that a company can raise money, by issuing bonds or issuing stock. Now, on the flip side, there will be an individual or another company buying the stocks or bonds of an organization. And when an individual or a company buys the stocks or the bonds of another company, they are actually recording an asset. And that asset is going to be recorded as an investment. Okay, so the first homework example is actually brief exercise 12-1. So let's read brief exercise 12-1. Let me highlight it here. OwnB Corporation. So this is the company we're going to do the accounting for. OwnB Corporation purchased debt investments. So what they did is they bought bonds for $52,000 on January 1st, 2015. So we, OwnB, are buying bonds of another company. Because we are buying that bond, we are going to record it as an asset, an investment, for $52,000. So if we take a look at the journal entry on January 1, you can see we're going to increase this asset called investments. And go ahead, we can call it debt investments. That's fine. It's an asset. That's the main thing. And we're paying cash for it, so we will credit cash. And that investment is for $52,000. Okay, so after we buy the bond, it says 6 months later, on July 1st, OwnB received a cash interest of $2,340. And as you've learned in a previous chapter, the main reason why an investor would buy bonds is so they can keep getting that consistent interest check as they're owning the bond. And that's exactly what OwnB is receiving right now. They're receiving an interest check of $2,340. So the journal entry is going to be, I'm going to increase my cash account with a debit, and I've earned that money, so I will credit interest revenue. All right, so that is an example of a debt investment. Now let's take a look at an example for a stock investment. All right, what we'll do is we'll take a look at brief exercise 12-2 in this case. All right, so we have a company, Shaw Company. What they're going to do is they're going to buy stock of another company. All right, and so the other company is going to record it as a common stock purchase in the equity section, but we're the buyer of that stock, so we're going to record an asset called investment. So on August 1st, Shaw Company buys 1,000 shares of Estrada common stock for $37,000 cash. Taking a look at that journal entry, you can see we're going to increase our asset account investments. And let's go ahead and call it stock investments. That's fine. And we will reduce cash with a credit for the amount that we paid, $37,000. Now that was on August 1st, and we held it for a few months, but we sold it. And take a look at the next part of this question. On December the 1st, Shaw sells the investment for $40,000 cash. Now you can see we sold it for $3,000 more than we bought it at. That is a gain. So take a look at the journal entry here. On December 1st, when we sell the stock, we will increase the cash account with a debit of $40,000, but we're only going to credit the investment for the original cost. Now here, the original cost, as we see, was $37,000. So if we bought it for $37,000 and we sold our entire position, we will credit the investment account for $37,000. The difference between the cash received in our original investment is either a gain or a loss. In this case, it's a gain. Remember, gains are credits, just like revenues. If there was a missing debit here, that would have actually been a loss. And a loss works like an expense. All right, so that's a very nice couple of warm-up exercises. Now let's take a look at some larger exercises. We're going to go to exercise 12-5. And what we have here is we have a company called Nosker Inc. And they actually bought into another company called Escalante Corporation. On January 1st, Nosker, and Nosker is the one that we're going to do the accounting for, Nosker purchased 2,500 shares of Escalante Corporation common stock for $152,000 cash. Now you can see here, I didn't read it, but let me highlight it here. You can see that it says 5%. What this means is that we, Nosker, are buying 5% of the outstanding common stock of Escalante. Now this is where it becomes extremely important because there are different accounting methods. As we studied in the lecture, there are 3 accounting methods for stock investments. When we buy between 0% or 0.1%, I should say, all the way up to 20% of another corporation's stock, we are going to utilize what's known as the cost method. When we buy between 20 and 50% of another corporation's stock, we are going to use what's known as the equity method to account for that investment. And last but not least, if we buy over 50% of another corporation's stock, we are effectively going to go through a consolidation where we're going to take their financial statements and our financial statements and consolidate it into one large company, basically combining the 2 financial statements. Now, what I need you to know for this course is the accounting transactions for the cost method and the equity method. The only thing I need you to know for the consolidation is when you would consolidate. I don't need you to know the details of the consolidation. It's an extremely advanced accounting topic, and in my opinion, it should be off limits for a Principles 1 accounting class. All right, so in this case, we bought 5% of the other company, so we will be using the cost method. All right, so with all of that said, let's take a look at the journal entries. So, exercise 12-5. Let me pull it up on your screen here. Here we go. Okay, so we said we bought that. Let's read it again. We purchased all of that for $152,000 cash. So, we're going to debit the asset account stock investments, and we wrote a big check. So, we will reduce the cash account with a credit. That was on January the 1st. Now, 6 months later, it says July 1st, Nosker received a cash dividend of $3 per share. Now, remember, how many shares did we buy? Well, if we come back up here to January 1st, we purchased 2,500 shares. So 2,500 times 3, that is $7,500. And what we're going to do with the cost method, and this is going to be different from the equity method, but with the cost method, when we receive a dividend, that is going to be recorded as a revenue. We are earning that money. It's like if we bought debt investment and we earned interest revenue, like we saw in a previous brief exercise here in this chapter. So very similar with the cost method. Whenever we get interest or dividends, since it's a stock investment, it will be dividends. We're going to credit dividend revenue. Okay, now let's take a look at December 1st. What did we do? We sold 500 shares for $32,000 cash. Now, what we need to know, well, we know we sold it for $32,000 cash, but what we need to figure out is what was the original cost that we bought it at? Well, how many did we sell? 500 shares. What was the original purchase price? It was $152,000 to buy 2,500 shares. Effectively, what are we selling? 500 out of the 2,500. We're selling 1/5 or 20% of our position. All right, so what we're going to do is this. The debit to cash, the author told us that. We received $32,000. Now we need to credit the investment account for our original cost. Now remember, the original cost was $152,000, but that was to buy the full 2,500 shares. But we only sold 1/5 or 20% of our position. Therefore, our original cost is $30,400. The difference between the cash we received and the original investment is either a gain or a loss. In this case, there is a gain because we sold it for more than we originally purchased it at. And so the difference of $1,600 will be a gain on the sale of the stock investment. And last but not least, December 31st, we received another cash dividend of $3 per share. Now remember, we originally owned 2,500 shares, but we just sold 500 shares. So how many shares do we have left? The answer would be 2,000. So 2,000 times 3, there is your $6,000. And you can see the journal entry, very similar to the journal entry back on July 1st. We will increase the cash account with a debit, and we will credit dividend revenue for $6,000. All right, so that's a nice example dealing with what we are going to call the cost method, because we bought less than 20% of the other company's stock. Now we're going to take a look at exercise 12-8. And in 12-8, you can see we have two independent situations. And let me be upfront with you. One of the independent situations, we're going to use the cost method. And the second independent situation, we are going to use the equity method. All right, so in number 1, Gambino Cosmetics. And so we're going to be doing the accounting for Gambino. They acquired 10% of the 200,000 shares of common stock of Nevins Fashion. Now, once again, 10% of the other company. Since we're between 0 and 20%, we are going to use the cost method for a total of $13 per share. So 10% of 200,000, that would be 20,000. So we bought 20,000 shares, and we bought them for $13 per share. So if we take a look at the journal entry for that, we're going to increase our investment account, and there's your $260,000. 20,000 shares times $13. And we wrote a big check, so we will reduce our cash account with a credit. So that is the original investment. Now what happens? As we own the stock, on June 30th, Nevins declared and paid a $60,000 dividend. Now, once again, that's $60,000 in total to all the stockholders. Well, how much of the $60,000 is ours? Well, what percentage of the stock do we own? 10%. So if you come back here, you can see 60,000 times 10%, or $6,000 is our dividend check. So we will increase the cash account with a debit. And as I just showed you in exercise 12-5, when we use the cost method, we will credit dividend revenue when we receive a dividend. Now the end of the year comes, and it says on December 31st, Nevins reported net income of $122,000 for the year. Well, when we use the cost method, we do not care what the companies that we made an investment in, what their net income or net loss is. We don't really care about that, at least accounting-wise. So this sentence that's highlighted, there is no journal entry required. But at the end of the year, what else does it say? At December 31st, The market price is $15 per share. And so what we're going to need to do is we're going to have to take a look at the difference between the current market price and the original cost. In this case, the current market price is $2 more than the original cost. 15 market price, $13 original cost. That $2 per share, and remember we own 20,000 shares, that $2 per share, we're going to need to record a journal entry. And this is a really important sentence too. The last sentence here says the stock is classified as available for sale. Okay, so what we're going to do is we are going to adjust for the $2 per share. And like I said, we own 20,000 shares. $2 increase in fair value times 20,000 shares. That's $40,000. And so we're going to debit not an investment account, but an account that is actually recorded or netted or combined with the investment account. It's called fair value adjustment. Now the fair value adjustment account could have either a debit balance or a credit balance. It depends if the fair market value has increased or decreased since we originally purchased it. If the investment has increased in value since we purchased it, this fair value adjustment account will have a debit balance, effectively increasing the asset. If it has decreased in value since we purchased it, we will have a credit balance here, effectively being netted against the original investment asset. Okay, and we're going to credit an account called unrealized gain. All right, now, because these investments are considered available for sale, the unrealized gain account is going to be a stockholder's equity account. That's important. Their other category is called trading securities. Now, a trading security, if it was a trading security, the unrealized gain would actually be part of the income statement. So it depends. And what is the difference? Trading, as we said in the lecture, trading security, basically the intention is for us to basically buy the stock and sell it for a quick sale. All right, and so if that's the case, the unrealized gains and losses would flow through the income statement. However, available for sale means we bought the stock, but it's not our intention to sell it right away. Now, of course, it's always available for sale. We can always sell it at any time we want. However, that's not our intention to sell it right away. It's more of a long-term holding approach. So, depending if your investment is considered a trading security or an available for sale security, it's going to determine how we record, or where we report, I should say, this unrealized gain or loss account. Okay, so those are examples of using the cost method. Now let's take a look at situation 2. And in this case, we're going to use the equity method. So we're going to do the accounting for Kanza. Kanza Inc. obtained significant influence against Rogan Corporation by buying 40% of Rogan's 30,000 outstanding shares of common stock at a total cost of $9 per share. All right, so you can see we are definitely between the 20 and 50% range. We're buying 40% of another company. So that is considered, and you can see the term here, we now have quote-unquote significant influence over this other company. We don't control the other company because we don't own over 50% of the stock. That's where we would have consolidated. But we do have much more control than if we bought less than 20%. All right, and because we're in that 20 to 50% range, we are going to utilize what's known as the equity method to account for these transactions. So we bought 40% of the 30,000 shares. So if you do the math, 40% of 30,000, that's 12,000 shares. 12,000 shares times $9, that works out to 108,000. And you can see the journal entry using the equity method. In this instance, is exactly the same as the cost method. When you originally buy the investment, you will actually debit the stock investment account, and you will reduce, because we paid cash, we will reduce the cash account with a credit. Now this is where it differs. On June 15th, Rogan declared and paid a cash dividend of $30,000. All right, and so these next two situations, there are differences between the cost method and the equity method. So the overall dividend was $30,000, and we own 40% of the company. So 40% of that $30,000 dividend is ours. That works out to $12,000. So we're going to debit cash, but instead of crediting dividend revenue, as we did with the cost method, we are actually going to reduce our investment, our asset. Because think about it, effectively what it is the stock, the company is distributing dividends. So we're effectively losing some of that investment value because it's being distributed to us. All right, so there's the difference in the credit. Instead of dividend revenue, we're actually going to reduce the investment. And here is something else that's different. On December 31st, Rogan reported net income of $80,000 for the year. Now, a few moments ago, when we used the cost method, I said to you, when the company we own an investment in, when they report net income, we ignore it accounting-wise. And that is true for the cost method. But with the equity method, we are actually going to increase our stock investment for our share of the net income. So the accounting is very different. We're basically living and dying with the net income and the dividends. All right, we're going to increase and decrease our investment asset account for our share of the net income and the dividends. We don't do that with the cost method. We simply record dividend revenue and we ignore the net income. So stock investments, $80,000 was the net income, and we own 40% of that. So 80,000 times 40%, that is $32,000. We're going to increase our investment account with a debit asset, and we will credit our revenue account, $32,000. So once again, this is a really good exercise, probably one of my probably the favorite exercise here in this chapter, because it really goes through the details of the differences between the cost method and the equity method. All right, very good. So let's go through one of the two problems that were assigned for homework. Let's go through the first one, problem 12-3A. So let me just scroll down so we can take a look at problem 12-3A. All right, and so problem 12-3A, you can see we have a whole bunch of journal entries. And the reason for that is we're owning multiple other companies. We're really developing a portfolio here. So the name of our company is called Turnbull Associates, and you can see at December 31st, 2015, we actually own 3 other companies' stock. We own 2,000 shares of Gehring. We also own 5,000 shares of Wooderson and 1,500 shares of Kitzleton. That was as of December 31, 2015. Now, in the next year, in 2016, there were multiple transactions that occurred. Okay. Now, I need to mention a few things before we get through these journal entries. You have to read the directions very carefully. What does it say here? It says we own the following securities held as a long-term investment. Now, a few moments ago, I explained to you when we own other companies' stock, all right, we're either holding it long-term or short-term. If it's held as a long-term, generally the whole idea is not to sell it right away. Therefore, we are going to consider these stocks available for sale. If they were held as a short-term investment, they would most likely be held as a trading security. Now, the next sentence is also important. What does it say? The securities are not held for influence or control. Now, control would be if we own more than 50% of the company. Held for and we would consolidate. Held for influence, we would own 20 to 50% of the company, and we would use what's known as the equity method. So it's neither of those. Therefore, I am assuming that all of these are going to be held using the cost method, meaning we own less than 20% of all of these companies. All right, so we got a lot out of those two sentences before we even go through any of the journal entries. And that's very, very important. You have to understand how much of the other company do you own. That is going to tell you which accounting method, either cost, equity, or consolidation. And are we holding it as a trading security, meaning short-term, or a long-term investment using available for sale? All right, so with all of that said, July 1, what happened? We received a $1 per share dividend on Wooderson stock. All right, so Wooderson, how many shares do we own? 5,000 shares. 5,000 times $1 per share. Very easy math. That is $5,000. And because we're using the cost method, we will debit cash and we will credit dividend revenue. Just playing devil's advocate, if we were using the equity method, the credit here would be the investment account. But it's not. Okay, August 1st, we received a 50-cent per share dividend on Gehring. Very simple. Gehring, how many shares do we own? 2,000 shares times 50 cents a share. That's $1,000. And you can see the journal entry is exactly the same as the first one. We increase the cash account with a debit, and we will credit dividend revenue. Now we're actually going to sell some of our position. So what happens on September 1? We sold 1,500 shares of Wooderson for $8 per share. Well, Wooderson, look at what our original portfolio was. How many shares did we have? We had 5,000 shares and the cost was $45,000. Well, if you do the math, what was our original per share price? Well, $45,000 divided by 5,000 shares. My math tells me that our original cost was $9 per share. How much are we selling them at? $8 per share. So that's a loss. Let's take a look. Cash, what are we receiving? 1,500 shares times 8. That's $12,000. Now we need to get rid of the stock investment with a credit based on our original price. And like we said a few seconds ago, that original price or original cost was $9 per share. 1,500 times 9 is $13,500. The difference between our original cost of $13,500 and the cash we received of $12,000, that $1,500 difference is a gain or a loss. In this case, it's a loss. We sold it for less than we originally purchased it at. Okay, October 1. Let's take a look at October. Wow, we're selling some more of our portfolio. In this case, we're selling 800 shares of Gehring. 800 shares of Gehring for $33 per share. Now Gehring, what was our original portfolio? 2,000 shares, and we're selling 800 of them. And what was our original cost? $60,000. So what was our original per share cost? Let's figure it out. $60,000 divided by 2,000 shares. My math tells me that original cost is $30 per share. And how much am I selling them at? $33 per share. So we are making a $3 per share gain. Let's take a look at the journal entry. We sold 800 shares times 33. So we're going to increase the cash account with a debit. $26,400. But remember, we're only going to take it off our books with a credit to the investment. The number of shares that we're selling, 800, times our original cost. And we just concluded that our original cost was $30 per share. That's $24,000. You can see we received $2,400 more cash than our original investment. That's a gain. All right, so September 1, I'm showing you an example of selling a stock at a loss. Losses have a debit balance. And October 1, I am showing you an example of selling a stock at a gain. You can see the gain has a credit balance. All right, so I think we're done selling stock, and now we're going to get some more dividends. November 1, we received a $1 cash dividend on Kitzleton. How many shares of Kitzleton do we have? 1,500 times 1, $1,500. Very similar to July and August journal entry, debit cash, credit dividend revenue. Now let's take a look at December 15th. We received a 50-cent dividend on the Gehring stock. Well, Gehring, we originally had 2,000 shares, but be careful. Back on October 1, we sold 800 shares. So how many do we own now? 2,000 minus 800. We now own 1,200 shares, and we're getting a 50-cent cash dividend. 1,200 times 50 cents, that is $600. Debit cash, credit dividend revenue for the $600. And last but not least, for the year, December 31st, we received a $1 dividend on Wooderson stock. Well, Wooderson, we originally owned 5,000 shares, but remember, back on September 1, we sold 1,500 shares. So 5,000 minus 1,500, we now own 3,500 shares, and each of those shares are going to get a $1 dividend. 3,500 times 1, there's your dollar amount. Debit cash, credit dividend revenue for the $3,500. All right, and so at the end of the year, you can see our stock balance. Our stock balance was $135,000 at the beginning of the year. All right, based on the original portfolio, but at the end of the year, the portfolio has a balance of $97,500. And how do we know that? Well, remember, let's take a look. Let's go through it at the end of the year. So December 31st, remember, the important thing we need to do at the end of the year is we need to figure out what are the differences between the original cost to buy our original portfolio and the fair market value as of the end of the year. This is important so we can update our investment account on the balance sheet. Okay, so at the end of the year, what does it say? Gehring has a fair value of $32, Wooderson is 8, and Kitzleton is 18. Remember these numbers, 32, 8, and 18. All right, well, what was the original price for Gehring? It was 30. Remember that? And what is it at the end of the year? 32. Wooderson, you remember this? The original cost was $9 per share. What is it at the end of the year? $8. And Kitzleton, we spent $30,000 to buy 1,500 shares. My math tells me that the original stock price was 20. And what is the market value at the end of the year? 18. All right, so what we're going to do is at the end of the year, we're going to put together a table. And in one column, you're going to have the original cost. And the next column, you're going to have the fair values at the end of the year. So let's figure out Gehring. Gehring, we own 2,000 shares, but we sold 800. So we have 1,200 shares left. 1,200 times 30 is the original cost. That's 36,000. The end of the year, 1,200 shares, but the fair value is 32. That's where you get the fair value. Now Wooderson, the original cost, like we said, was $9 per share. How many shares do we own? 5,000 less the 1,500 we sold was 3,500. 3,500 times 9, that's where you get the original cost. The fair value, 3,500, and as we said, the market value at the end of the year was 8. That's where you get your 28,000. And lastly, Kitzleton. Kitzleton, we never sold anything, so our original cost was $30,000 for 1,500 shares. There's your $30,000. And the end of the year, we said Kitzleton has a fair market value of $18. That's where you get your 27,000. So our original cost, 97,500, but the portfolio has a balance at the end of the year of 93,400. And so one of the last journal entries we need to put together at the end of the year is we need to compare our cost, our original purchase price, to the fair market value. The difference is going to be either an unrealized gain or loss. In this case, the market values are $4,100 less than our original cost. That will be an unrealized loss, which we will debit. And we will credit this account called fair value adjustment. Remember, the fair value adjustment account is going to be combined with the investment account on the balance sheet. Unrealized gains and losses using the equity method, they're going to be part of the equity section on the balance sheet. So when we prepared a balance sheet, we would show the investments, and you can see the investment. You see the 93,400? That's the fair value. And what does that represent? The investment account of 97,500 has a debit balance, and the fair value adjustment has a credit balance of 4,100. Those two balances combined, that's what this number is. And like I said, last but not least, the unrealized gain or loss, it is going to be reported in the stockholders' equity section of the balance sheet. And there it is. You can see it's got a debit balance, so it's actually going to reduce overall equity. And be careful, because the unrealized account may have a gain or a credit balance, which would increase the equity. You need to be very mindful of that. All right, so that is a good homework problem to go through, so you can see all the transactions using cost method. These are all important. Make sure you understand the cost method and the equity method, and make sure you know when you have to do the consolidated financial statements.